So, panel 4, I have the luxury to have with us representatives from two of our portfolio companies, Christophe from Baubap, our first transaction at SixPoint, Miguel from Monet, one of our latest transactions at SixPoint. We have Jason, who's our dog lawyer, lenders counsel. We have Tom as borrowers counsel, and we have Mike from Cascade, our trusted data agent who is with us in every single transaction. So, thanks for having us here. And of course, sorry, my boss, AJ. Sorry about that. So, since we have portfolio companies here with us, let's start with you guys. Christophe, Miguel, from both of you. So, when preparing for debt from the borrower's seat, what kind of internal work is most essential before approaching institutional lenders? What type of documentation, controls, risk insight you feel like need to have in place before approaching a lender?
I can start, Andrew. And this is like speaking with startups all the time. Like they feel like a pitch deck is good enough to raise debt. That would be the case for equity. Generally, you could raise equity with a simple pitch deck, but with debt it's totally the other way around. When I was in Baubap, I had a chance to be a corporate banker lending to other companies. So we knew when we started discussions with SixPoint what was expected, right? So ever since day one in Baubap, even though we weren't raising debt, we started building our PR and had complete control of our unit economics, of all the legal documentation, all the risks, and who owned those risks, right? Because what we saw, what we knew was that lenders don't expect perfection, but they do expect control and overall good documentation. So when we first started talking with SixPoint, we already had this VDR built with all of this that we knew we would have wanted as lenders. When AJ and I, whenever they sent their first list of documentation they wanted, I think it was like 24 hours later, they had 100% of the information analyzed and everything. And yeah, so I think like starting the company with a strong VDR is basic nowadays if you're gonna raise debt sometime.
Talk is absolutely correct. Also, just to be clear, Baubap is a little bit unique in that regard. We unfortunately encounter a lot of particularly early stage platforms that don't have their data rooms in order before we start talking to them. Leandro bears the brunt of that.
I learned that the hard way.
And learn the hard way, and it can significantly create a time suck to getting a transaction closed. Now, this is not to say that whether it's us or any other private credit fund that is your first institutional investor, our due diligence data room requests, lists, documentation, questionnaires, and so forth, they're pretty standard. There's not anything that's extraterritorial that other institutional private credit funds would ask. But it's not uncommon, particularly for some of the earlier stage, seed stage founders in the room, that might not have that documentation. And at least for SixPoint, that's okay. It's not a moment where we would walk away from the transaction. Other private credit funds might, but for us, when we see something like that, we're very happy to lead in and help you draft that documentation alongside you, not only to satisfy our underwriting requirements, but because it's good housekeeping. It's good to get that stuff done so that you can start institutionalizing yourself. But we've been very lucky and fortunate that both Monet and Baubap, who we're both very proud of, had very impressive due diligence data roots from day one. And in fact, it's a testament to the two of them, basically.
Miguel, same question. What do you think you need to be ready for before approaching a lender?
Yeah, I totally agree with what both of you just said. In our case, I believe one of the important things were understanding from the facility perspective what they will need to see and what they want to see. And additionally, since this wasn't the first step to get that on the market, we used prior cases to implement and reinforce our data room, our metrics, our unit economics. And the first thing was, when we initially raised debt, it was with friends and family, for example. And it was from our perspective that we needed to construct a dashboard, a very simple one, so they could have the trust in Monet to see, oh, my investment in that in Monet is going this way. And we started with little simple Power BIs. Then we got a little facility from Colombia, which is Colombia's biggest bank. And then they started asking new questions, not only from the financial perspective, but also from the operational and cybersecurity side, which is very important at these stages in the fintech sector. And then we just were like, when we are ready to raise a structural debt, we will have our data room in order, and we will guarantee that all the information we are looking at to make the business or the portfolio grow in a healthy way, we need to be ready to give that to a third party so they can provide us a new structure and a new facility with the trust they need.
And out of curiosity, was there a lot of overlap between the information that Bank Colombia was asking and what we were asking, like private lenders from one side and like banks on the other side, or was it completely different?
Actually, it was similar. The process with Bank Colombia was very particular because it was a special group of the bank focused on early stage companies. So the onboarding process was really different from what they traditionally do in the bank. But the main documents were always the same. They want to see the loan tape, they want to see the checkup from cybersecurity, and one important one that was very interesting from your side is the impact that our portfolio is doing in these people in Colombia.
Okay. I'm going to ask the same question, but to the lender now. AJ, when you approach a fintech, what makes you say these guys are ready for us? When you look at the information they provide to us on that first approach.
Okay, I'm going to answer this in potentially two ways. I'm going to answer it purely from a SixPoint perspective, and I'm going to answer it as if I was just an independent sort of advisor to fintechs that was looking to raise from any sort of institutional debt. I'll do the second one first and the SixPoint. I think for most private credit fund investors, and Mike can definitely chime in here as well as a former CIO of a private credit fund and obviously deals with a lot of private credit funds in addition to working with SixPoint. But I think that if a VDR is not ready, if they don't have a handle on what's going on in their business, internal controls and procedures are lacking, I think there's a fair, healthy portion of private credit funds that will likely say, we're not ready, or you're not ready, and come back and see us in 6 months or 12 months. I think it's not that common, or it's less common, that a private credit fund will roll up their sleeves and work with a platform to fill in the gaps during diligence and underwriting, where SixPoint is one of those. There's probably a few others that do that. What we look for when we're evaluating a platform, obviously the business model is important. We want to make sure that if we're going to invest the time and energy, and we're also going to, again, act as advisors with a checkbook, classic sort of British merchant banking model, that we know that it's a business that can scale. We're not in the business of just writing a $10 million check and having it just kind of languish, but we're happy to go small and rise with the business. But we really need to understand, okay, like the founding group, the business model, this is a scalable business model, and the team that they have in place is the right team for scale. So it's not dissimilar, at least from our perspective, to what a venture equity investor would look like from that perspective. The other thing that I think is very important for us, because of the advisory angle that we marry with our capital, is we need to know that the team is coachable, okay? Coachability is a very important part. We've turned deals down where we felt like the founders thought they knew it all, and they weren't open to being coached. And not to toot my own horn, but I've been doing this for 30 years. Like, I'm 29 years in, and we've got a lot of experience and depth in our team. We've got very experienced lawyers that we work with. And frankly speaking, it's very rare we see a group of founders in emerging markets that have that level of experience. And so the guys that really get us excited, guys and gals, that get us excited is when they're like, we definitely want to partner with you. We're open to your suggestions. We're open to your advice. teach us that overcomes a lot of shortcomings that you may have with the platform or the documentation, internal controls and procedures. The humility and the humbleness that comes with that goes a long way, right? Mike, I don't know if what your experience has been with other paraprofessionals in that respect.
Yeah, everyone's a little different, but I would agree that you got to make a good first impression, right? It's like any other fundraising. If you are doing very well, there's probably a bit more leeway for how bad your data room is or things like that, right? VC deals sometimes go across and it's clear that no one's really doing due diligence on this stuff. But I'd say that's less and less common, and for most of the folks out there, it actually doesn't take that much work to get your ducks in a row ahead of going out. It does make a difference, and you can reuse a lot of the stuff from many other investors. So, yeah.
Yeah, and just one additional point is before the VDR, you need to do a thorough due diligence on the lender as well. You need to understand their motivations, what the investment thesis is, if it makes sense, if they're going to be good coaches.
Just the right partner, that's what you're saying.
Exactly. At the end of the day, it's going to be a partner, and you also we weren't able to do that part of the due diligence because we were the first deal, but you need to talk with other borrowers of the lender to understand what happened, how did he go, and it went sideways. Also, it's very important to have a very plain due diligence on the lender as well.
Where's Brian? Is he still here? Brian, here?
So
So Brian says doing a debt deal is getting married and getting divorced at the same time, right? So there's definitely some validity in that. We, in particular, we will turn deals down if we perceive that we're only being used as a short-term bridge. We want to build long-term strategic relationships with our platforms. It's the reason we take the equity warrants in our deals for long-term alignment of interest. Our capital is super flexible to allow us to be restructured into mezz when a bank wants to come in and do senior, because that's what it means to be a long-term partner. And that level of diligence for any founder out there on who you're getting into bed with is super important. The only thing I would say is just like, and this is, I've had this question asked of me just recently, like 3 times in the last 2 weeks. Somebody comes at you who is opportunistically wanting to do your deal because they feel it's a yield pickup and it's still cheaper than what I might provide. Good luck having a long-term partnership with them, because the first time that they don't have a specific mandate like I do, okay, or like others that we rub shoulders with in our markets that are dedicated emerging market fintech private credit funds. Guys who, whether they're in New York or San Francisco or London or whatever base, they're coming to do one deal because they know someone who knows someone and they want to just pick up yield. They're the first bank, first investor that will cut tail and run when there's a breach of a covenant. They will not sit there and work with you because it's not their mandate. And so if somebody's coming at you and I'm offering you X and the other guy's offering you 200 basis points cheaper, that's where the background comes in. It's not just a pricing discussion. It's about, can I see myself in a situation where shit goes sideways? And is this person going to stick around and work it out? Or are you just a rounding number on a larger portfolio that you don't need to headache and they'll just cut you loose? And for an early stage and a growth stage fintech platform, winding down a facility can be like tantamount to death, right? And so you've got to pick your partners wisely.
I was just going to weigh in on the legal side for preparation. 2 points I'd make. The broader point is there's going to be a lot more focus on your assets. Okay, so complying with regulation is going to go to the value of those assets, whether they're good, whether they can be challenged if you're complying with consumer protection laws. We've seen that in the UK with some of the auto financing. We need the question that makes it hard to lend against if there's doubt about that. So we need more focus on that. The other thing that came up on a recent deal that I was doing is your contracts themselves. If they are like really short-dated contracts, you can fix it. But we've gone into deals where you're trying to take security or securitize receivables, and the contracts are just garbage, and they have confidentiality restrictions, or they have transferability restrictions, and sometimes that just can't be fixed for those old contracts, or it's very hard to. So if you're thinking about this sort of debt financing, when you're putting contracts in place, don't
whether you weigh in from the borrower side. Does this readiness or lack of readiness affect you guys that's from the borrower's counsel side?
Yeah, I think maybe pick up a few points that Christophe and AJ were making. First, how should I say? You really do need to do your due diligence on your lender. I'm just going to scan the room to make sure I don't offend any lenders with what I'm about to say. There's going to be, I would say, we're all at a SixPoint event here, and we all know the value presentation that SixPoint brings to the space. There are larger funds that will come and kick the tires on you, and maybe it's because they just want to learn more about your company, because when you grow to a certain scale, they'll want to approach you. Maybe they're curious to learn about your specific market segment, and this is a good way for them to do so. There's also the opposite end of the spectrum, and there's going to be debt providers that don't have committed capital, or they're using you to grow two sticks together and create fire to get going. And you want to make sure that you really understand who you're getting into bed with. And
let me stop you there.
Yeah.
How do you do that?
I think some of it's what Christophe described, and I imagine you had the benefit of folks like Baubap coming before you. I think there's some simple questions. Here's what I think. It's kind of like when you're first dating somebody, right? You're kind of, I think I made a joke about this last year, but let's say my wife and I made this joke. You're not underwriting the person across the table. And you're also underwriting the people around them. Hey, what do your mutual friends say? And I think to AJ's point, one of the things you should expect in any debt relationship is you will have defaults, you will have amendments, you will have things that come up. This is not just something where I'd love to tell you that it's like a super smooth, fast process to close a debt deal. It may be, but it's not a super serious lender on the other side of the table. So understanding, I think, have you done deals in my asset class? Have you done deals in my market? What are some, to Christophe's point, in terms of vetting your coach, right? Girl playing football, your coach says, give me 5 push-ups. You're not going to get that 5th push-up unless you feel you have it in you and that person is really motivating you. Does this person feel like they're the right person across the table to coach you? Those are just, I think you have a lot of agency as a founder and an operator to be able to make those decisions. So ask the person questions across the table that may make them feel uncomfortable, and ask about them. I think this is a relationship industry, but this is an industry. This is a business. So you shouldn't be bashful about putting some of that stuff out there and see what comes back.
And I would just add also that the equity investors in your cap table can be a really good resource for reference checking and also just bouncing ideas off of them on what you might be hearing. Particularly if you've got an investor like Brian or Y or others at the early stage, these guys have already been through it before with other portfolio companies, and they can basically say this is consistent with what I've seen with my other portfolio companies, or this is really not consistent. There's a flip side to that now, because we've experienced that when you have less experienced equity investors or family office-y kind of people that are not sophisticated, and then you come at them with a market standard term sheet, they look like a deer in headlights and they can't really help you. But definitely more often than not, when you're doing your due diligence to find out if you can partner with your first institutional debt provider, your equity investors would definitely be a good source, a networking source.
Let's change topics for a bit, but we're staying close to the legal side. So structuring the deal. How do you select the right structure for a particular deal? For us at SixPoint, we do deals in multiple jurisdictions. So jurisdiction is an issue, but it's not the only issue that determines the type of structure that we do. So from the borrowers, from the lenders, from the assistance that the data agent can have, from the legal aspect, like how do you choose the right structure for a particular deal?
Okay, so this is actually really great because we have Baubap and Monet. One is from Mexico and the other one's from Colombia. And the financing structures for each of those deals are different, but they actually serve the exact same fundamental underlying investment mandate from SixPoint. We have to do a deal where the assets are completely segregated and bankruptcy-remote from the operating company. That is a specific stipulation in our own fund documents and what our investors gave us money to deploy and be good stewards of their capital. Other investors, I think Alex is, or Daya is still in the room. And so Alex at Deep Ocean, he has a broader mandate. Pedro at Adam Capital, he has a broader mandate to do as more flexible. But ours is bankruptcy remote, securitizable or asset-based lending. Now, structurally, we're driven by the local jurisdictions on how that works. In Colombia, we were able to do a true sale, a very traditional true sale securitization. In Mexico, there is the true sale securitization route, but it's not necessarily as straightforward. And you can still get there with an assignment pledging of collection rights using fideicomiso, and my Spanish is horrible, apologies. After working with Doucet for 4 years, I would be better, but finance interest.
And having 50% of your team.
I know. So when we go into different jurisdictions, we try to stay open and accommodating in terms of what the local jurisdictional legal requirements are. Jason Fields calls for me probably every 2 weeks when we're looking at a new jurisdiction or an email, and I'm like, hey, do we do this true sale? Do we do this assignment pledging? Can I get a non-consolidation opinion? It's around the principle of it, per se. Now, other private credit funds might not have that investment stipulation. And obviously, Jason and Tom and Mike work with other private credit funds that don't necessarily have that stipulation.
My partner who didn't make it, Rich Davis, said that if you can, as a borrower, if you got a lender that'll lend you money on one piece of paper, take it, right? What do you want? AJ's talking about something a little bit different, but it's not unusual. And I think your question went a little bit broader. What are the other elements of the financing? We do, with AJ, we do warrants, there's guarantees and other elements, but the core of the security to get the money back on these structures is you put all the receivables, all those assets into a box, right? And that's an SPV, it's a trust, it's something like that. If in the worst case, the borrower goes bust, SixPoint is not in some local court trying to enforce on these assets that are running away. It's grabbed those assets and it's servicing them, either itself or with a backup servicer, and it's able to grab them immediately. That's how these work. That's actually a standard securitization structure that I do that for securitizations around the world on hundreds of millions of dollars of deals, like big, huge deals. And it's that technology that we've taken for the much smaller deals, but it's the same stuff.
Something very important in getting to that goal of taking this structure, global structure into each jurisdiction is choosing the right legal counsel. So at that, both the local counsel and New York counsel can talk in the same language and understand what they are doing in the local jurisdiction. In our case,
Sorry, when you mean same language, you mean English or you mean legal language?
the same legal language.
It's important.
And also I'm covering lawyers such as AJ, so just since the beginning we tried to choose in Colombia, which had the track record and understood several past transactions. So
Their Colombian Borrowers Council was so good on the transaction that we're now going to hire them as our lenders council on future Colombia deals. So they were excellent, and you showed us very well.
Give their business card out later.
Yeah, it's quite a process.
yeah, I know. From work perspective, since I was a lawyer before, it sounds even expensive to hire a law firm, a top law firm that can comply with these requirements. But it's worth the effort, and it may be a
It's actually, so let's talk about the cost thing for a second, and this will prod Tom and Jason a little bit because of everyone's complains about legal fees on transactions. And no, I know.
we're being charged for this.
No, he's not good. He's not billing. Tommy, you're not billing, right? I could make 100 lawyer jokes. But yes, the way I look at it, there's two groups of legal fees. There's like good friction legal fees, and then there's like ridiculous wasteful legal fees. We're trying to address the ridiculous wasteful legal fees by building software that can automate workflows and do a lot of the scribe-based work that has just defaulted to lawyers over generations of doing transactions. I want Jason and I want Tom on the transactions because I want their legal advice, and I have no problem paying for that. I don't want them to be spending time running black lines at proofreading documents. Now, the age of AI agents is now upon us, and we don't need to spend, I don't know what Jason's fees are. I don't want him to be billing me for proofreading. But to Miguel's point in particular, you pay with peanuts, you get monkeys, okay? And that is certainly true with lawyers. And so don't try to skip out on paying legal fees or trying to save a buck with getting a law firm that doesn't have the experience to do this kind of transaction. It'll end up costing you more because Jason will, if it's a lender, if it's borrower's counsel that doesn't know, frankly, they're asked from their elbow when it comes to this kind of stuff, they will have to be taught and educated by Jason on every single clause. And then he's going to bill me for that. And then I get reimbursed by the borrower. So it ends up being less efficient.
Mike, come to you. You've seen that given Cascade, your platform, you've seen tons of data platforms. Is it possible to predict if a transaction is going to go smooth from the data you're getting before the close of the transaction? Is that something that you can start foreseeing?
We got the metadata of like how good was this data before it went to the investors and stuff is something that a lot of our investors ask for. So we do a lot of work cleaning, validating, standardizing data. But a lot of the investors have come back and be like, hey, how was it before you cleaned it to us? It depends where we come in on the deal. In terms of the success level, I'm going to be very honest. We get put on deals often enough that the data is terrible and it's a live deal, right? And so I'm not going to say if you have poor data, you're not going to get a deal through, because that would be talking my book, but it's simply not true. We see bad data all the time on really big companies, large deals. Like we were on a deal, one of the largest lending fintechs in America, public. They sell all their loans to big investment banks in the US. We got thrown on there. It was like a $500 million deal. And we found errors in it. And we were just like, how is this possible that a very public lending company in the US who's selling probably billions at this point to banks are still like, it's very basic, hey, the DPVs don't line up. And so I'm not going to say there's like an indicator there, but I think if you're looking to raise, everyone here knows Ramp. A few years back, the head of capital markets at Ramp at the time, Alex, he's since left.
He was supposed to be here today.
He wrote a great post on, hey, this is what we did to raise money. And even Ramp, who has a really good system, they were smaller back then, they spent 3 months just getting their data in order, right? And so it is something you should focus on. It makes life a lot easier for everyone involved and probably does move the needle. It's one less thing for an investor to worry about. But just given all the stuff we see, I wouldn't say it's disqualifying either, unfortunately.
Hey Jason, you just explained how the blocks, the banks are remote. Now, how do you structure to control for downside risk and lender protection? Tom, how do you challenge that and defend the borrower's interest in a transaction?
I think with these sorts of deals, the main protection is putting those assets in a box, right? You've got borrowing-based concepts, so those assets have to have a value, and there's eligibility criteria. This is all securitization technology, so only the good assets or the eligible assets go in. I think what that does is, at least in principle, it allows you to release a lot of other lockdowns of the business that you might want to have. You're really saying, I'm looking at these assets. If these assets are here, then with caveats, otherwise you're able to go and do other things without us breathing down your neck. Tom?
So I think, let me pick up with, I think AJ's mentioned this too, but where Jason left off with these sort of receivables in the box. You kind of go back to kind of the caveman approach to lending, and you think, okay, my first way out of the deal is that I'm paid as I'm supposed to. My second way out of the deal is where I need to make sure I'm doing my proper underwriting. And my third way out of the deal is some distressed sale or foreclosure action, right? And when I'm looking at this on the borrower side of the ball, I am trying to take that structural reality and make sure that we can maximize flexibility in good faith. So what that means, and we'll just take through that sort of three-pronged approach that I mentioned, you start with the box of receivables, and I think the really important thing to do is come in good faith with a standardized program. And having the BDR is important. I would say that's a cosmetic indicator of a deeper underlying reality, which is you have a good program, you have good underwriting standards, and You're committing with your lender, this is what I'm going to do with your money. I think if in good faith, you say, look, we've actually made some changes. Here's some empirical data to validate something more expansive than what you're suggesting. A good lender on the other side of the table is aligned in putting out more money and making more money together. If you get into the world of potentialities and what ifs, yeah, man, what if we got into letting on Mars or something? You probably go back to your lender at that moment in time and have a conversation, get an amendment for your Martian denominated facility. But just don't waste time with that stuff out of the gate. Just stick to what you do, stick to doing it well. The receivables should work out if you've done your job well and your lender's done their underwriting well. Then they're going to turn next to, okay, if that doesn't work out, what's my secondary source of repayment? That's going to be coming at you, the business, directly. One of the things that's really important, and this is the subject of some back and forth, is understanding, and one thing to Jason's point, and I think to AJ's point, there's different sort of buckets of covenants here, right? So you'll have off-balance sheet kind of portfolio performance covenants that speak in real-time data that you guys are validating as to whether or not the actual collection on your portfolio is, relatively speaking, in line with some expected level of variance. Nobody expects every single borrower is going to make every single payment as contracted, but you start to see some deprecation in credit quality, and that's going to have a cascading effect on your facility. But let's say that you messed that up. Then now they're working through their progressions. What's their secondary source of repayment? It's going against you as a company, and they need to make sure that your financial operating ratios make sense, that they have some visibility to make sure that you're not running out of capital. They are providing often a much deeper advance rate than other folks in the market might, so they're a little bit closer to the razor's edge. And at the same time, you need to be able to run your business. And so that can be the subject of some back and forth here. Hey, what are reserves that I need to maintain? How can those reserves be unlocked to me? At the same time, I think you need to appreciate two things that can be true. From AJ's opening remarks today, the exhibited default rates on this paper is not as scary as a lot of people who are less experienced might think. At the same time, to Jason's last point around backup servicing, at least in my perspective, the risk of a successful servicing conversion event taking place in emerging markets is much more significant than in developed economies. And so making sure to not talk like a robot, what I mean is servicing isn't just like the payment processing on your collections. It's actually stepping in, collecting on those contracts, making sure that there's boots on the ground, a voice on the phone to collect. There's significant risk if things don't go well. In many emerging markets, even in one of the very first deals I did when I was a first-year associate at the first law firm I worked at, Puerto Rican subprime deal, United States governing law, none of the borrowers paid when we did a servicing conversion. So if the borrower goes under, the best way to make sure that you stay in line with those default rates is to make sure that you actually have some of these protections in place. The best offense is a good defense. The best defense in this case is to make sure you don't run out of money. I think you start on that point, and then just very quickly, not to monopolize the panel, the sort of give to get that you need to appreciate. It is like venture capital when you get your first institutional credit facility. It's in a similar way to how your first lead investor on a priced equity round being on preemptive rights to participate in or lead other rounds. Often, if you have a long-term committed capital partner like SixPoint, they're going to want to be able to go along for the ride with you. And I think one of the things that I often see for entrepreneurs and operators who do not come from a specialty finance or structured finance background is it becomes an afterthought thinking about the capital evolution and diversification of your funding base. And so understanding what happens in the happy path and being able to negotiate that out of the gate, understanding from the lender side of the table, for as many times as you go from 10 million to 100 million in originations, there's just as many prime war stories of folks who aspire and never fully deploy, or worse yet, blow up, and there's actual loss. I could go on, but really don't stop.
I just want to pick up on one of the things you said about service or substitution. So for those that are not necessarily that familiar, I think it's important to spell this out a little bit. For the fintech founding, for the early fintech founders in the room, effectively you're originating loans, and then what you're doing, what's called servicing the loans, you're actually collecting on the payments, both the interest and the principal. When you've raised capital on balance sheet, whether it be from equity or friends and family or venture debt, the expectation is that you're financially, the investor comes in and says basically, okay, we're going to lend to you. We're going to look at the loan portfolio, but we're looking at you as a whole. When you start to move to an off-balance sheet facility, effectively what happens is the roles can formalize where you're not only the originator, but then you're also what's referred to as the primary servicer. In more developed markets like in the United States and in England and in other places, Canada as well, it's not uncommon for a loan originator to not continue to be the primary servicer on the loan, particularly for banks, right? The servicing rights, it is an asset class in and of itself. There are professional service companies that just do primary servicing. And I think that for direct lending businesses, particularly early stage in emerging markets, you need to understand that when you become a primary servicer on a asset-backed securitization deal, you're going to be looked at on the health of you in that capacity, in that role. Okay, so that's where the on-balance sheet covenants come from. It's what happens to keep the lights on if I have to wind down the portfolio, even if I am a backup servicer in place. Because even when you do backup servicing and you do substitution, particularly for high velocity, short dated instruments like what Baubap has and what Monet has, things can go sideways very quickly. And you could go from like default rate of, or non-collection rate of, let's say 6, 7, 8%, and then you had a substitution event, and it could literally 50% could literally evaporate. And so what we spend time doing, and what other lenders like us spend time doing during diligence and also in negotiation, is saying, okay, how much capital do you need to keep the lights on if we have to execute a substitution event? Because you still need to be there to support the backup servicer, otherwise things can go really bad, right? And backup servicing, let's be clear, we've got representatives in the room from a variety of different jurisdictions. Backup servicing in emerging markets is extremely nascent. We're doing Cascade, we pushed Cascade to do backup servicing for us in Indonesia, on our first deal in Indonesia, because prior to that, there was no backup servicing capability in the whole Indonesian securitization market. So it's even getting a backup servicer is, in certain cases, is not available.
It's almost like a liquidator in this case.
Yeah.
It's not a business as usual option.
Yeah.
Let's talk a little bit about soft skills. So, getting to the finish line, closing the deal, and even afterwards, requires a lot of meetings, a lot of talking, a lot of negotiation. Sometimes those negotiations can be tough because borrowers and lenders' interests might be aligned but not necessarily the same. So you need to negotiate, defend your own stance, but at the same time you need to coexist and keep the trust, right? So how do you do that from the borrower side, from the lender side?
Miguel, why don't you go first?
As any other negotiation, there are good days, bad days, but I think the main point is if you have the same goal and you are in the correct path since the beginning, you should be able to manage those conversations and those tough times to get into an arrangement. And what we did basically in our negotiations to make things better was always using the data to get into agreements.
Yeah.
And SixPoint team was always very open to look into that data. And although conversations can be tough, we always got into an agreement. And basically that was because we were led by data, and the data proved that we could change some terms, that some things could vary and get into the final goal.
The way I would put this, and these guys will smile when I say this, other guys in the room who are about to kick off deals with me, you'll hear this speech. I won't give the full speech because I don't want to steal my own thunder, but I will say this. When you do a deal with us, I think this would be the case with any serious your first institutional debt investor, you're going to hate us by the end of the transaction, by the end of the due diligence and the underwriting process. It is invariable that you will hate me at the end. It's just par for the course. It is like going through boot camp. It is hard. And I always tell the platform on the kickoff call, you will hate me at the end. And it's okay that you hate me at the end. Hold your fire. We'll get to closing, and then I'll ask you in 6 months after we close if you still hate me or you love me at that point. And it's a rite of passage. As long as you are, and this is what I've taught every one of my 6 pointers, as long as you operate with radical transparency with the people that you deal with, and you explain to them where you're coming from, why this is important, and you're acting in good faith, then you will, as Miguel says, you will eventually, if you're led by data, you will come to and understand it. It will invariably happen.
Yeah, to complement, I was going to say something similar to Miguel, but you started with the soft skills, and what you need in order to negotiate are hard facts, led by data. So I think we learned that quickly enough, but it took some time, especially with AJ. But at the end of the day, if we want to negotiate something, the first thing we do is internal negotiation within ourselves, and we get all the data that needs to be put in front of the SixPoint team for them to understand. And once they understand, I don't know how many times you said, oh, now I get your point.
Yeah.
And I agree, and let's go
The
forward.
guys have been the same way. We're so blessed and fortunate, particularly with these two portfolio companies, that when they come to us and they say, AJ and the team, we need a waiver for this, or we need to move a position on this, they come prepared. They always come prepared, and it makes my job and our job that much easier. And it also, the other thing about it is it goes back to the soft skills. Let's remember that if you either follow the traditional 4 C's or 5 C's of credit, whether it's 4 C's or 5 C's, one of those C's is always character, right? So character means a lot in credit. If you come at us and you've done the internal debating, you've done the legwork, how can I not? How can I not be like, okay, I get this, I understand this?
Especially you add the complexity of the language, because even though we all speak English, there's a language barrier sometimes. The culture and the legal or the legal different structures you have within different countries, you need to, because you have some idea in your head and then you come to me with that idea and I'm like, sounds amazing, but that's not doable here in Mexico. And then I'm just thinking, AJ, in Baubap, we originate 24/7. So Saturday, Sunday, holidays, whatever. And
2 a.m.
2 a.m., yeah, at whatever time. And we do have this bankruptcy-remote structure in place where it's operated by banks in Mexico, which don't work, basically don't operate Saturday, Sundays, and weekends. So we have to finance sometimes even 5 days with our balance sheet, the loans were in and out on those days. So we knew we could have made the bankruptcy readiness of about SixPoint. So we went and did a lot of deep work, and we were able to find a way to automatize whatever the trustee was doing in Mexico. So we basically do have them there because they're what makes the structure bankruptcy-remote. But now we're able to originate. We don't need to finance those days because basically, within the payment processor, we optimize everything that the trustee does in there. And it has such an impact that now even BBVA came to us and they're replicating those mechanics we built with SixPoint. And it's gonna make a difference to a lot of people in Latam, at least. So yeah, facts at the end of the day.
Awesome. Okay, one of the last questions we're close to the end. So again, this question is, I'm sorry, Mike, I need to get your input. Like, as the data agent, like, what role do you play in all of
Yeah,
this?
and we're neutral. We're Switzerland. Data is a science, right? It's not like equity where it's like, oh, I think I'm going to grow 6x this year. No, I think you're going to grow 4x. There's no right answer. In debt, it's A, is this eligible, right? What was the calculation you agreed to in that after you got all your lawyers involved? We can show you all of that. Now, I think to touch on a lot of the themes of today is we do see a wide range of how investors react when something is different, right? There are investors out there who, it's very by the book. You breached, it's too bad, right? My IC won't give you anything here, we gotta wind this down. I spoke, this was like 2 years ago now, Mexican company raised $75 million from a large institutional investor. They only managed to deploy 1.9 of it. Why? Because they pivoted their business, they did another product, it wasn't in the eligibility. The lender, for whatever reason, it takes 6 to 12 months to close one of these things, didn't want to amend. And they ended up in a situation, okay, we can't go out and raise again. We're growing here, but now we don't have the capital. And then they, of course, now I'm talking my own book little, but they weren't keeping track of things either. They started getting breaches. It's too late. They pulled everything. Company's gone now, right? And that is the other end of the spectrum. Then you have the investors who are a lot more flexible. I'd say for earlier stage investors, generally they know there's going to be some sort of breach at some point, right? And so you have to have the relationship. I often say in these days, why do investors do in-person due diligence? Right? It's not just to see, oh yeah, the building exists, right? Like a lot of fintechs, there's like, they're in a WeWork anyway, right? And it's not to go in and be like, oh yeah, we looked at all the paper documents and everything. Everything's digital now, right? And how hard is it to create something with AI? I say the main point of the in-person due diligence is to start that relationship, right? And that's why we come to this every year. We see these guys so that when the crap hits the fan, there is some foundation to have a very honest conversation. It will get ugly, right? But ultimately, you want to find an investor who's willing to see it out, because we see cases where it's not the case.
I would just add to that. Ray was in the back room. He's the CEO of Monet, and you've got other portfolio companies here. When we do on-site due diligence, Andrew will tell you this, I explicitly require a one-on-one CEO to CEO breakfast, where it's literally just me and him, and it's usually the day before I leave, and I look into the eye and I say, keep me under the tent. Keep me under the tent while we go through this. If you don't keep me under the tent, I can't help you. And that's an important part of our process. If we feel like you're giving us the Heisman, or you're keeping at arm's length when stuff is going sideways, it's very difficult to continue to help. The earlier you bring us in, it's not been smooth sailing for the last 4 years, but thank God we're still here. And I love these guys, but 2 years ago there was a difficult period. But to their credit, they came and they called me. I was in a train in London, remember? And I got the phone call. I was on the Heathrow Express in London. I remember it vividly. And it was like, they were like, AJ, just so you know, this is about to happen, and I can work with that. It would have been really hard if I had not heard from him, and then 2 weeks later, I just get a notification sent to me in an email saying this, or I got a notice from Cascade that there was a breach to this, or a red light for that. So it really, the relationship, the soft skills, keeping your guy under the tent is super important.
Okay. A couple more questions and then we'll open for Q&A from the public. Again, from the lender side, runaway side, and from the lawyer side, debt in local currency or in hard currency? Pros and cons.
Local currency, there's no cost.
AJ?
Again, talking your own book, I think Mike will, validate this. He said that we've started a trend now a little bit, but I think we decided strategically last year, being pushed by Christophe and his team, we went through our first restructuring that we would only lend in local currency and we would do the hedging ourselves. And the reason for that, we heard a lot of pushback from people in last year's conference as well, right? Equity investors. Brian, who's not here, Brian said it as well. Originally, look, right now we raise, all of our capital is dollar source capital, right? So it's very easy for a private credit fund to basically say, I lent you in dollars, you gave me back in dollars, and you have to hedge. And if you want capital from outside of your country, you have to do that. We were also smaller and not as big as we are today, and it was not possible for us to be able to do funding at hedge level before we did this restructuring last year. But I think now that we made that determination, in hindsight, I would advise early stage fintech lending platforms to see if you can get local currency, to get your private credit fund to give you the loan in local currency. You have too much to worry about, frankly, operationally. We put a lot of, I wouldn't say pressure, but we put a lot of onus on you for reporting, internal controls and procedures, and then just to layer on top the hedging component as well. It's a lot, particularly for an early stage platform. If this was I think Ting, I don't know if Ting's still here, but Move is a much more mature platform. They're in like a dozen geographies. They have a treasury team. That's a different kind of animal at that point. They can potentially handle hedging. They might be able to even get better execution than a mid-sized sub $1 billion hedge fund, for example, or private credit fund. But in most cases, we're very happy that we made the decision. Obviously, our portfolio companies are grateful for that as well. And I don't know if you're seeing that with some of the other funds you work with.
Yeah, we've seen other, again, the devil's in the details, right? So, oh yeah, I'll lend you in pesos, and what they're actually doing is they're going to hedge it themselves and mark it up 200 basis points and just pass it on to you, right? So that's not common. Actually, something I always encourage every company to do is when they're like, hey, we're looking to raise money now. Of course, eventually I bring up SixPoint, but I'd often say, honestly, if you can raise local money, local family offices, local banks, local sources, do that first. Don't go to the U.S. private credit funds. Don't go to the international guys, because they're truly local. They're just going to be able to give you a much better rate in almost every jurisdiction we see, and it's a tangible difference. It's when you need to scale, then you go to the SixPoints of the world, and then you figure it out from there. But certainly, I think it's a no-brainer for local currency.
It also depends on the terms. You just mentioned local currency. You can get a loan, for example, with a local bank, from the office. But for example, in this transaction that we started with US dollars, and we have to do the hedging, it was also a no-brainer. Although we had some credit lines and facilities in Colombia with local banks, the financial terms were very different. Maybe an interest rate that would be lower, but for example, the advance rate is very hard. With Colombia, we had a one-on-one collateral. With we get up to 90% advance rate. So there's also, it depends a lot on the financial terms and the commercial terms you're agreeing upon. If you have these same terms, but in local currency, it's obvious. Yeah, the local currency works better.
Look, I think the holy grail for all of us is, SixPoint goes around. We have the guys from Malaya in the room. Malaya helps us raise money from local LPs in local currency because we're building a partnership with them, and that's great. And we can pass that on. We don't have to pay. We don't have to get the hedge. We don't have to layer on the hedging costs. Unfortunately, right now, I still have to pay a minimum return in dollars to my LPs. And remember that. I talked about this in my opening remarks to a little extent, talked about it more last year, but hedging cost cannot be at the expense of the expected return from dollar investors. Because even me being a dedicated EM private credit fund, my LPs are not dedicated EM LPs. And they're looking at what returns I'm going to bring them on a relative value basis for where they can actually put the money into other funds. And so if I say to them, hey, I can generate X, and they say, that's great. And then I have to then say, it's not going to be X anymore, it's going to be Y because I have to eat the cost of the hedge. They're going to pull their money from me. And so the Holy Grail is if I can get a little currency LP money and there's a natural hedge, that's great. We will continue endeavor to try to, as we widen the water fund and expand our capital markets platform, we will try to raise locally. But there should be no dissolution here from any non-US based emerging market private credit fund lending founder. If you're taking money from a dollarized fund, even if I'm taking off the table from you the hedge management, the hedge risk management, the operational side of doing the hedging, I'm not going to eat the cost of it. If you are going to pay, the cost in local currency will be reflective of what our dollar return is plus the cost of the hedge. It's just, that is what it is.
Okay. And to finish, and sticking with the tradition for today, bold prediction for 2026. What do you think is going to happen in the market? What do you think nobody's talking about, but it's something that you feel it's coming? We'll start with you.
Let me do a quick, my cause for optimism. I think the rapid development of stablecoin adoption, especially for B2B payments, I think is a really interesting.
It's the fourth time somebody's mentioned.
We'll talk about it.
I think especially the hedging local currency conversation, I think it's a really promising topic. I think it's a really promising topic on the capital market side. I think this is more a cultural observation than a political observation. I think some food for thought is the increasing regionalization or fragmentation of the world, and especially I think at a conference like this where you're talking about really ambitious, exciting fintechs in emerging markets and money centers historically that have been very far-reaching in terms of access to capital globally, being a little bit more insular, and I think that just underscores the need to make sure that you're working with capital partners that know how to navigate all that. But that's something I hope we don't see, but I expect we will.
Bold prediction for 2026. Colombia winning the World Cup.
That's a dream, not a thing.
No, in Latam, what we are looking at, and especially in Colombia, is open finance and open banking. We have been working with these concepts in Monet for the past 5 years, but it's becoming a reality from the regulatory perspective. And since there will be more data, we will be able to create new products, we will have more competition, and that will be very interesting for Colombia and Latam in 2026.
My bold prediction. So something that I think is probably underpriced at the moment, I just looked this up on Polymarket right before this, is I think there's actually a bigger chance than people are thinking of rates going higher this year. I think with all the noise with the Fed and stuff, and obviously Trump wants it lower.
Japan.
But at the same time, look, I'm Canadian, so I definitely feel like there's a lot more geopolitical risk right now too. But if you look at the data, GDP growth is decent in America, even in Canada. Job growth is strong. The economy is doing well. And inflation, as we all know, is going higher, especially with more tariffs. And so I think it's going to swing from being like, oh yeah, for sure they're going to cut this year just because I'm going to get kicked out or whatever, to a more, okay, there's actually a shot that rates go up by the end of the year. So what does that mean for a lot of lenders is make sure your unit economics are strong, right? If inflation's going up, we've all seen where gold is, and there's less political appetite to make the Fed less independent, and the economy's going strong, then I think the conversation can change. And right now it's like a 1% bet on Polymarket that rates can go up at the end of the year, and I think
Take that bet? No investment advice though. Right?
Yeah. I'm just Switzerland. I don't have an opinion.
Jason?
Well, I'll stick to my lane. I don't know if this is bold or 2026, but AI is not going to put lawyers out of business. But what it's going to do is it's going to make all the complex deals that only the big guys can afford available to the little guys.
AJ?
That was going to be one of my bold predictions, is that using AI to democratize structured credit more. We have our annual firm all the SixPointers here. We have our annual firm offsite tomorrow and Friday. And one of the key initiatives for us is to be able to use our software and also more broadly AI to reduce the execution time it normally takes for a deal to close from 6 months down to 4 months on average, or 3 months. We're going to try to push that as well.
You said 4, AJ.
I did say 4, but I'm going to push you on 3. I would love nothing more than to get through everything we need to get through, and we can use workflow automations and AI this year, but we could never use that before. So I don't know if that's necessarily the bold prediction. I don't want to piss on the campfire or be negative, because everybody who knows me knows that I'm generally a positive guy, but I do have a little bit of a negative bold prediction, and it's only because we just recently went through this experience in Indonesia. I don't think what's happening in Indonesia is going to be isolated in Indonesia. I think we're going to see it in many other geographies in emerging markets, and that is rampant fraud, and the combination of that with the pricing to perfection of SME credit from commercial banks not having enough excess spread to weather the storm and having liquidity get sucked out of the market. We're seeing it already in Saudi, double pledging of trade receivables. The Saudi regime has this promissory note structure that was supposed to be ironclad, and that under Sharia law was going to be completely enforced by the courts. And now, just in the last 2 to 3 months, creditors have brought what they thought were slam dunk cases before courts, 3 courts, to get their promissory notes enforced. And the courts have basically said, we have no way to decide because you double pledged. Hence why having somebody like Cascade on all of our deals is super important, and why we use Cascade as a first of its kind transaction in Indonesia. which heretofore was not there. But I think we're going to see, unfortunately, a lot more rampant fraud and that kind of thing happening in Indonesia and other emerging markets, sadly. And maybe that's part of the learning process and the evolutionary process of this market. But yeah, I think, unfortunately, that's my bold prediction.
Christophe?
I think I had like my whole prediction, but it was already said in a part in an earlier panel, and now Tom just referred to it as well. But I think they said earlier that forward flows were going to replace the traditional lending, and Tom just said that stablecoins were going to replace traditional lending. I think forward flow through stablecoin.
Nice.
It's gonna be
Let's do it.
what's gonna happen by the end of 26, and it's gonna help replace traditional lending and
I'm all
traditional
for it.
forward flows.
I'm all for it. Forward flow, actually, it's very interesting. We've been trying to get a pilot off the ground with Baubap. We have Fernando here from Jetta. We're talking to them about potentially doing a forward flow in Brazil. It's obviously much more prevalent in the United States and in developed markets. It's less so in emerging markets. You definitely need a more mature lending originator with a lot of track record. We obviously know these guys like the back of our hands, so we're very comfortable with them. Jetto's been doing this for more than 10 years. They've got such a long track record. It's not going to be for everyone, forward flow. And for those who don't know what forward flow is, it's a fancy way of saying whole loan purchasing. The fintech basically just originates the loan and the investor takes 100% of the risk. It's on their balance sheet. And the originator just earns an origination fee and maybe some economics on the back end of loans that are successfully repaid. And it's very interesting because in the United States, we've seen this massive migration from ABL into forward flow. In Asia, actually, forward flow was more used than ABL for a period of time. But so I do think we're going to see more forward flow transactions in LATAM this year and also in the Middle East.
Through stablecoin.
Stablecoin, yeah, sure.
Right, so we're almost back in schedule, so we still have time.
Question. I have a question. Following one of Leandro's questions regarding pros and cons of local currency and hard currency and capabilities, we usually discuss this and with the platform, and they usually say that the only cons is the cost, because maybe they perceive like the local currency more expensive. That's not exactly the case when you just factor the hedging cost, right? But my question is, when you focus not only on the cost, but also on the advance rate, for example, because when you take into account the advance rate, then you need to factor the cost of the equity, and then the cost of capital is totally different, right? But that transition from the way usually you think on this business, only on the debt and the interest rate you charge to your clients, to factor the capital is very difficult. And many deals drop off because they say, no, this is just expensive. No, it's not expensive. You need to take into account the equity, right? So my question, or what I would like to help me, or to help every entrepreneur right now here in the room, is how to change that mind. Because you need, usually it's like a way of thinking, because it's not only like a typical net interest margin decision, right? It's not, I'm lending at 100% and I'm paying 30% in the cost of the debt. No, you need to factor the portion of the equity as well. But I know Monet and Baubap follow that transition, but many early stage platforms struggle thinking in that way. So I would like to listen from you guys how to do that, how to advise.
Okay, so I'll go first and then please have others chime in here. And this actually goes, this goes to answer part of another question about what's a green flag versus a red flag on platforms that we might be interested in partnering with. If there's a platform where there's a founder group, where there is not somebody in the founder group who understands principles of corporate finance and has literacy, and it doesn't have to be a CFO, but somebody who actually understands corporate finance and financial operations, that's going to be a problem, because you could talk to them until they're blue in the face about weighted average cost of capital or a WACC analysis, and if nobody understands what that means, you're never going to get through to them, right?
Yeah, I don't know how to answer that one, because at the end of the day, if you're talking with SixPoint or they're talking to you, they should know this.
Yeah,
it's like
I think what he's trying to tease out is that because we've experienced this a few times with early stage founders, that they look at, when we like layer the senior and the mezz, and then they say, shit, the mezz is super expensive. And then we're like, yeah, but if you take that, and then you didn't have the mezz and you had to use equity, like what are you implying the cost of equity to be? And 5, 6 times out of 10, the guys that we talk to don't have an implied cost of equity, cost of capital.
I guess that's the answer.
Yeah.
That's basically is showing them how to work out a WACC and understand it. You should be good to go, sir.
But it's impressive because, for example, if you talk to local banks in Colombia, the first only question is, how much will SixPoint charge? You start explaining this, but they say, we're cheaper. And you say, no, you have to calculate the advance rate, the repayment period, etc., to get into a full analysis. And maybe for the platforms, it will be easier to make a comparison between how much equity you need to get into a $10 million portfolio and how you will do it in a traditional bank.
And the duration too. Most of the local, with the exception of certain places like Mexico and Brazil, most of the local commercial banks and even the local capital markets, the depth of the market isn't there. So you might get 10 million, 20 million, but you never get 50 to 100 million or more. And then duration is typically an issue. Like it's typically 12 months and then they want to start amortizing. That is worth minimum 3 years interest only. Sometimes can go out to 5. That's pretty consistent with international private credit funds. Part of the process.
So just to add on to that, I think this would only really apply to guys raising one of their first facilities, right, who haven't gone through it. I think something I often say to folks in that space is there's basically 4 things in a term sheet that you're optimizing for. It's generally size, cost, leverage, flexibility.
Yeah.
And we often say out of those 4, usually what like first-time fundraising founders focus on are size and cost. I can get 50 million at 10%. This is the best thing. And honestly, my opinion is you should focus on the other 2, the leverage and the flexibility. First of all, size, I think, matters the least, right? Like, especially with your first facility, if you are doing another 5 or 10, you can raise more down the line, especially if you did well. If you didn't do well, guess what? It doesn't matter if you raise 50, they're going to call me that default. The cost, I get it. But again, what's your goal? Is your goal to get to 10 million and just stop? Or is it to get to 50, get to 100? The cost right now is going to be high. You're new. But it'll come down naturally as you have more track record. And so actually it's the leverage and the flexibility. So by the leverage, what's the advance rate, right? Because in the early stage, you probably don't have that much money. Equity is even more expensive at that time. And you're legitimately deciding, okay, do I hire this person or do I squeeze another 50K into my borrowing base? So that's super important just because that's your most scarce resource. And then the flexibility, like we've talked about, having the relationship, stuff like that. If you change your business plan, are they going to keep funding you, right? If you do need to prepay, and we know SixPoint stands on this, but we also see funds out there who are like, hey, I'm just here to bridge you for 12 months. We have very low prepayment fees. That's often better to optimize for. And everyone's going to be different. There might be someone out there who's, oh, no, my equity, I got tons of it. I don't care. So yeah, go for it, right? But generally, that's how I would think.
So completely agree. Yeah.
Anyone else? Yeah.
Hi.
I'm Laura from CXC, and we currently have the role of backup servicing for Baubap in Mexico and for Monet in Colombia. We actually launched an office here in the US last year. So my question, AJ, when you mentioned the predictions for 2026, we were talking about emerging markets, but last year the US also a lot of events happened.
TriColor.
Yeah. So I wanted to know if you see the role of backup servicing getting warmer in developed markets. And on the other hand, in emerging markets, what are you looking for to lower the risk?
That's a great question. I can just point to we're very proud of the transaction we just closed in Indonesia for Wansermak. It's the first of its kind transaction in the Indonesian market. We're actually going to be, I don't know where Max is, but we're going to be publishing a white paper on it hopefully next week. It is the first of its kind transaction because we are using a master servicer, a data agent, and a backup servicer. We're using a cooperative society, which is a legacy Dutch colonial legal regime in Indonesia as the SPV. We try to really, from a structuring perspective, address all of the shortcomings that have come out of the Indonesian market related to fraud. And that's not the only jurisdiction where we will do that. So we had a deal last year in our pipeline in Ghana, for example. We tried to get CXE involved in that. We unfortunately didn't get there, not because of the Ghanaian fintech platform, but ironically because the regulator wouldn't give us the ability to do a true sale securitization in their country, which doesn't make any sense because they're a Basel III member state, but whatever. But in Ghana, there's no such thing as backup servicing. In Nigeria, there's no such thing as backup servicing. South Africa, there is. In Kenya, maybe yes, maybe no. I think, at least from where we stand, we will always insist on there being a backup servicer involved in the process, either a hot backup or a warm backup. I think that's going to always be part of our process. But we're a little bit more conservative in that regard. Mike's already said this. He comes across a bunch of lenders who he's surprised by the lack of diligence that they do on transactions, or the fact that they would be willing to close deals with mistakes in their DPD analysis and things like that. We're not that. And just to say, we're going to continue to see additional things like TriColor in the United States. The cockroaches comment it's not going to go away. Mike actually did a great post on that in LinkedIn last year about that it's not the canary in the coal mine kind of thing. I think there's a lot of, to end on a positive note, is to say that I don't see this, I do have this as a bold prediction, that I do feel that there will be more frauds akin to what we saw in Indonesia, akin to what we're seeing in Saudi and in others, and it will make everybody just do a check and to be like, okay, this isn't just the halcyon days of liquidity going out into the market. We have to be careful. And for all the other guys out there that want to raise debt funds that aren't credit guys because they want to get debt going, this is exactly why this stuff happens, because you're not necessarily dying-the-wool credit guys, and you let that happen. We will not let that happen when we do our deals. We will impress those standards on our transactions, and we hope to God that the others that are supporting the ecosystem will also stay to that level, that standard.
So in an effort to stick to the schedule and get back to the agenda, I think we can call this meeting to an end. I think this was a fantastic panel, perhaps the best of the day of the afternoon. We still need to see if panel 5 can live up to the expectations, but for the moment, guys, we rocked it. Congratulations.